Okay, in this video series, we're looking at some integrated financial planning areas. Specifically, we're focusing on some time value money calculations that pop up in education planning. Three steps here in education planning are the same as some examples in retirement planning, so that's the next video that we're going to do. We took quite a bit of time in the education planning video. It's like 32 minutes. But if you've watched that one first, in this one we're going to go through the same three steps, but for a retirement planning scenario, and we're going to do it at a much quicker pace. So if you find the pace is too fast, you want to go back and watch that child education planning video first, because it's at a slower pace. So the topic for this video is retirement planning, and we're going to highlight the importance of using the correct interest rates. Okay, we're just going to jump right into this scenario so we can see we're going to look at a retirement planning example. This is slide 1 of 5 that we're going to go through. And so you can see here that the scenario is assume that your client John wants to retire 18 years from now with the inflation adjusted equivalent of $45,000 additional annual income above benefits provided by the government or employer pension. So that's $45,000 in today's dollars. John's planning on retiring 18 years from now, and he wants to have, in today's dollars, that purchasing power, okay? So as John and the financial professional discuss his retirement, the two agree to plan for 20 years of inflation-adjusted income in retirement. So here we are at time 0. John's planning to retire at 18 years from now, and then he's planning to be retired for another further 20 years. Okay, annual inflation is stable at 2.5%. John's portfolio is earning 6% annualized after fees. So the example that we're going to go through here is how much money will John need today if he wants the entire amount in place at the beginning of his retirement, and number 2, how much money will John need to save every year or month starting today if he wants the entire amount in place at the beginning of his retirement. Okay, the 3 steps for the calculations for retirement planning and education planning are the same. So if you've watched the video on education planning, have gone through it, you know what I'm talking about. If not, that's okay. This video will stand alone on its own, but I'm going to go at a little bit of a quicker pace, okay? So step number 1, what we need to do is we need to inflate the current cash flow amount or expense for the number of years until required. So that is the start of retirement or university. So this date is in the future, and we do that to determine the first year's cash flow need. So this step uses the rate of inflation only, and that means our IY is going to be 2.5. That's the rate of inflation. So we can see here at time 0, John wants to preserve purchasing power of $45,000 in today's dollars, but he's planning to retire in 18 years, so N equals 18. Present value equals 45,000, N equals 18, IY equals 2.5. There's no payments in between, so the future value is going to equal 70,184.64. We can use algebra. Future value equals present value times 1 plus I, that's the 2.5% to the power of N, that is the 18 years, okay? Then step number 2, what we're going to do, so that's the amount, today's dollars 45,000, 18 years from now, that's 70,814. That's an annual payment that John wants at the beginning of each year, anticipating retirement for 20 years. So step 2, what we do is we calculate the amount needed at the beginning of retirement or university in the education planning to fund the inflation-adjusted cash flow required for the client to maintain purchasing power throughout the anticipated retirement period. So this step uses the real inflation-adjusted rate of return, and it's almost always calculated as annuity due, present value annuity due, i.e. payments at the beginning, okay? So when you do that, when you have your future value here of 70,184, that becomes your payment, okay? But what it's saying here is that I can earn interest on my investment account, because we're calculating the full amount that I needed here 18 years from now to begin 20 years of retirement, you can see in the first year, the deduction out of that account is going to be $70,184. Well, I'm going to be earning interest on my investment account, but at the same time, I'm going to be losing purchasing power every year as I go forward because of inflation, and that's why we use the inflation-adjusted rate of return for our IY. And recall how we do that. That's the real return is 1 plus the return nominal divided by 1 plus the inflation rate, and we minus it by 1 and times it by 100. Okay, so that's important. Step number 2, the discount rate is a real inflation-adjusted rate of return. So that's going to equal, you see just over $1 million here, $1,039,567 to fund 20 years of payments, where the payments are coming out at the beginning of the year. So the last step, number 3, is we can solve either for a lump sum amount that we want today or annual payments needed today to accumulate the retirement fund. So this is just a present value calculation. This present value of the annuity due becomes your future value. And again, N is going to equal 18. The interest rate in this case is your investment rate, and you're going to solve for the present value. So if you have $364,000 today, 205, and you invest it for 18 years, at the end of 18 years, you'll have $1,039,567. From that account for the next 20 years, you'll be able to take out your first payment, $70,184.64. And for the next 20 years, those payments will increase at the rate of inflation. At the end of 20 years, you'll have no money left, okay? And just to remind us that in this case, the IOI that we're using is the 6% investment return net of fees. So you can see here, in first step, it's using the inflation rate, discount rate of 2.5%. Step number 2, we're going to be using the inflation-adjusted rate, which is 1.06 divided by 1.02%. And the third step, we're going to discount back at the investment rate, okay? So here we are jumping into step number 1. Assume John wants to retire 18 years from now. Inflation adjusted equivalent of $45,000 in today's dollars, additional annual income. Annual inflation is stable at 2.5%. So step number 1, we have to calculate what $45,000 in today's dollars is worth 18 years from now. So we'll just bring up the calculator, check that we're in periods per year equals 1. And that is going to be 18N. Inflation is 2.5%. The amount in today's dollars of extra income is $45,000, so we'll make that a negative. Present value, there's no payments in the interim, and we're going to compute the future value. We can see it's $70,184.64, okay? Now, if we wanted to use it just the algebra, future value equals present value times 1 plus I to the n. We would do 1.025, that's 1 plus I. Y to the x, we're going to do 18, and we're going to multiply that by the $45,000 present value, and we're going to have $70,184.64. Okay, so that's step number 1. So step number 1 is done. $45,000 in today's dollars is worth $70,184.64 18 years from now. So the step number 2 is we're going to calculate the amount needed at the beginning of retirement to fund the inflation-adjusted cash flows required for the client to maintain purchasing power throughout the anticipated retirement period. This step uses the real inflation-adjusted rate of return. So this future value becomes your payment. N is going to equal 20 years of retirement. Future value is going to equal 0. Payment is going to be $70,184.64, and then we're going to compute for the present value, and the interest rate is going to be 1.06 divided by 1.025, the nominal rate. We're going to use the real rate, 1.06 nominal rate divided by inflation, 1.025 minus 1 times 100, okay? That's step number 2 that we're heading into right now. Okay, so here we are, step 2. We have to determine the amount needed to fund the next 20 years of John's inflation adjustment retirement income payments. So N is going to equal 20, but we said in this case we need to use the real rate. How do we do that? This is the real rate is 1 plus the nominal rate divided by 1 plus inflation minus 1 times 100. So the investment rate is 6%. The inflation is 2.5%. So 1 plus 6% divided by 1 plus 2.5% minus 1 times 100 gives us a real rate of 3.4146. Okay, so just bring up the calculator here. 1.06 divided by 1.025, and then we're going to minus 1, multiply by 100, and you can see that 3.4146 is the real rate that we're going to use. Okay, payment is our $70,185. We calculate that in step number 1 is our future value. Future value equals 0. So when we compute our present value, it's 1,039,567. But remember, we're doing this as a present value annuity due, so we need to put the calculator in the beginning mode. So let's bring up the calculator here, and we're going to put it second begin, second enter. So now we're in the beginning mode. Going to check again, second PY, just make sure, yes, we're in 1. So it's going to be 20 years of retirement, 20N. Here we're using the real inflation adjusted interest rate, 3.4146. That's going to be our IY. And we're going to calculate the present value of this annuity due. Our payment is $70,185. And that's a payment into us. And there's going to be no future value at the end of that 20 years. So we're going to compute the present value, $1,039,000. Well, some small rounding here, 567 versus my calculator 574. Probably taking this from the Excel. Okay, we're going to show you the Excel. What I'm going to do is going to run through the calculator first and do the Excel from A to Z rather than jump back and forth in this video. Okay, so that's the step number 2 done. The present value of the annuity due, we need $1,039,567 at the beginning of 20 years of retirement to make a payment at the beginning of every year for the next 20 years. So the third step here, we can either solve for a lump sum or we can calculate annual payments needed starting today, every year, every month, to accumulate the retirement fund. So we know that if we want to have $45,000 in today's purchasing power as extra income 18 years from now, well, 18 years from now, because of inflation, that would be $70,184. That's the first payment that we would want at the beginning of 20-year retirement. Every year there's going to be a payment done at the beginning of the year. Those payments are going to be increasing by 2.5% to maintain the purchasing power. And we're also going to be earning 6% on our investment account on average net of fees. So you can see in the first year I have this retirement account that is designed to pay me $70,000 in the first year for 20 years, inflating at the rate of inflation. Okay, so now that I know that $1,039,567, that becomes my future value, and the last step is just to figure out what that amount is today, knowing that I could put it in an investment account at 6%. So if I had $364,205.77, then at the end of 18 years, earning an average rate, compounded annual average growth rate of 6%. At the end of 18 years, I'm going to have $1,039,567, and that's going to be enough money to fund myself for 20 years of retirement. Okay, so step number 3 is just a present value calculation, and in this case, the IY that we're going to use is the 6% investment rate. So you can see here, step number 1, we used the inflation rate, 2.5%. Step number 2, we used the real rate. And step number 3, we're using the nominal investment rate. So all 3 steps use a different IY. That's important that you pick up on that, okay? So here we are, step number 3, determine the amount needed today to meet the goal 18 years from now, or determine the amount of monthly or yearly savings. So here we can see the calculator's back into the N mode. N equals 18 years until retirement. Here, IY, we're using 6%, the investment rate. Future value is that $1,039,567. So we're going to compute the present value, $364,205. So let's bring up the calculator, get it out of that beginning mode, second begin, second enter, clear, clear. Okay. So just check again, always PY equals 1. Yes, that's fine. So we're going to have 18N, 6IY, and the future value is 1,039,567. That's our future value. There's no payments, so we're going to compute the present value, and it's $364,205.84. So put another way, if I have that amount today and I invest it at 6% in general on average, compounded annual average growth rate, then 18 years from now, I'm going to have $1,039,567, and that should be able to fund me retirement for 20 years. Okay, grinding that account down to zero. So that's step number 3. Okay, what we're going to do here on this second to last slide is we're just going to look at step number 3 again, but instead of looking at the present value, what amount we need today at time 0, we're going to look at what payment we would put into a retirement fund, savings fund, this year and every year for the next 18 years if I'm making the payment at the end of the year. So that would be an annual savings program. We could compare that against annual bonuses, etc., and see whether it's realistic. Or if we change the periods per year to 12, we could look at a monthly savings plan and seeing if that looks realistic as well. So let's just bring up the calculator. Again, we're going to be in the end mode. Just going to check for the first one, PY equals 1. So we have 18N. Our investment rate is 6%. We're looking at no present value because we're going to start our savings now. We're looking at $1,039,567 as the amount we want at the retirement count 18 years from now. So we're going to compute the payment. We can see that we'd need to make an annual payment starting this year and every year for the next 18 years, $33,636.79. Now, again, what we can do is change that to a monthly. Second PY, change that to monthly. 12, enter, and clear that. So again, it's 18 years, so 18 second NN, N equals 216, or I could enter it as 216N, fine, different strokes for different folks. 6 IY, no present value because we're starting our savings plan, 1,039,567 as my future value. So again, I'm going to compute, in this case, a monthly savings. I need to have monthly savings of 2,683. Look at, I did 2,638. I'm going to change that to 83 and 77 cents. Okay, and just like that magic, I compute my payment, $2,683.77. Okay, so just going to click into the last slide here, and we can see, just to finish this up, we went through the 3 steps. Step number 1, inflate the current cash flow, $45,000 in today's dollars. What would that be 18 years from now when I want to retire to maintain my purchasing power? $70,184. That becomes an annual payment for 20 years of inflation-adjusted income in retirement. So at the beginning of retirement, I need $1,039,567. If my investment account earns 6%, inflation is 2.5%. The amount that I would need today is $364,205. Earning at 6%, I would have $1,039,000 at the end of 18 years, and that would be enough to fund me 20 years of inflation-adjusted income in retirement, starting with the first payment of $70,184, which is the equivalent of $45,000 today. Now, I could also set it up that I want to make a monthly payment of $2,683 into my retirement savings plan. So that's the last slide. The next thing we're going to do is just go through this Excel. For those people that like Excel, again, this video will be on my website, these slides that you can download, plus the Excel spreadsheet. Okay, we're just going to run through this example in Excel. So the annual income in today's dollars is $45,000. That's what we want to preserve in terms of purchasing power, but we're not planning on retiring for 18 years from now. Then we're planning to retire for 20 years. Our interest rate that we can earn net return on our investments, net of fees, is 6%. Inflation is 2.5%. So the real return is 3.4146%, which is 1 plus the net nominal return divided by 1 plus inflation minus 1. Okay, so you can see here step number 1, what is $45,000 in today's dollars worth 18 years from now? So we did that already with the financial calculator. Periods, N is number of years is 18, periods per year is 1, so X times PY is 18. We use the inflation rate because it's $45,000 in today's dollars. What's it worth 18 years from now? So present value is 45,000. Future value equals present value times 1 plus I to the N. Or we did it with the financial calculator. Or here we can do it in Excel, calculate the future value, 70,184.64. If I just delete that just to show you how to do that, equals future value. Then I hit the bracket. It's asking me for the rate first, so I click on the rate, but it's important that I divide it by the periods per year. Then I hit comma. Then it's telling me to pick the number of periods, N, then comma, it's asking me for the payment, hit comma, asking me for the present value, hit comma, asking me for the type, 0 at the end of the period, 1 for the beginning of the period. We're using N, so it's a 0. Finish my bracket, hit enter, 70,184. Okay, so that's step 1. Move into step 2. We want to determine the amount needed to fund the next 20 years of John's inflation-adjusted retirement income payments. So in this case, we're going to use the real rate, 1 plus the nominal rate divided by 1 plus inflation minus 1 times 100, 3.4146. So we're using the real rate. Retirement is for 20 years. Single payment at the beginning of every year. So PY equals 1. N equals 20, IY 3.4146. That payment, the future value up here, becomes our payment, and we calculated the present value of $1,039,566.79. Okay, so we can see here. Then we move into step 3. We'd say, okay, what is the lump sum amount that we need today? So that $1,039,567 becomes our future value. That's 18 years from now, retirement. Period per year is 1, so N equals 18. Again, we're back to the end mode for the calculator. Here we're using our nominal rate, our investment rate, so we solve for the present value. So if we had $364,206 today, invested at 6%, at the end of 18 years, we'd have $1,039,567, and that would be enough to provide us with a retirement income for 20 years, starting at $70,185, increasing at the rate of inflation 2.5%, protecting our purchasing power, and having $0 at the end of 20 years. Then if I just scroll down a little bit, what we did here is that we did it if we had to do an annual payment at the end of the year or a monthly payment, $263.77. So you can download this Excel from my website and with the PowerPoint slides. So here I am at my website, profted.com. If I just click here under CFP, because this is CFP related content, click on FP Canada. You can see I have a link here to FP Canada. George Brown is a FP Canada approved core and advanced curriculum program provider. I've got a link here to some competency profile videos that I've done. Here we get into a little bit of a video series. I did a video on the FP Canada case protecting the family. In that, there was a little bit of funky math on the discount rate that they were doing in terms of the time value of money, 3 steps for the education planning. Therefore, I did a education planning video, which I go through the steps very slowly. There's the slides for that, and then Excel. Finally, we're in this retirement, time value of money, 3 steps for the retirement. Here's the slides, here's the Excel, and there's the link to the video, okay? Okay, I'm just going to finish this video with a bit more Excel here. This is a nice to know. It's not really a super need to know the ins and outs of all the calculations, but I just want to highlight the importance of why we use this inflation adjusted return for step 2 when we calculate the balance that we need for the beginning of the retirement, okay? So recall step number 1, we have $45,000 in income or expenses that we want to cover. In today's dollars, we're planning to retire in 18 years. Inflation is at 2.5%. So step one, we calculated that 18 years from now, $45,000 would be the equivalent of $70,185 if I round it, okay? So for step number two, that's the payment that I want for at the beginning of the first year of retirement, and I want it to increase to protect my purchasing power at the rate of inflation, 2.5%. And I want to have $0 at the end of 20 years of retirement. So when I do my calculation, we're calculating the present value of annuity due for a stream of payments. My payment is the $70,185, which was my future value from step number one. We're in beginning mode here because the payments are made at the beginning of the year. You can see that withdrawal at the beginning of the year. The periods per year is 1. It's 1 period payment at the beginning of the year, so n equals 20. But here it's very important that we use the real inflation-adjusted interest rate, which is 1 plus 6% divided by 1 plus 2.5% minus 1 times 100, 3.4146%, okay? So you can see when we do that, we calculate the present value annuity due, $1,039,567. That is the balance that we want at the beginning of retirement. So you can see here at the beginning of year one, we're going to take out that first withdrawal for the first year. Balance goes down to $969,382. We're going to earn 6% interest on that because we have a balance in our investment account. And so at the end of the year, we're going to have $1,027,545, which is just my balance after the withdrawal, plus my investment return, and that becomes my balance at the beginning of year two. End of year one is the beginning of year two. Now you can see here, this is why it's so important that we use the inflation-adjusted rate. My withdrawal is not $71.85. I'm inflating my withdrawal by the 2.5% because I need to protect my purchasing power, and that's why we use the inflation-adjusted rate of return. So as I scroll across here for 20 years with a rate of inflation at 2.5%, you can see that at the end of 20 years, that payment actually is up to $112,201, and at the end of the 20 years, I have no balance left, okay? So that was very important that we used the inflation-adjusted rate, because I just want to show you, if I scroll down here, what I've done is I've done another example, okay? So you can see I've done another example, but I've incorrectly used the investment return. And I'm also inflating my withdrawals, but as we know from time value of money, as I increase my discount rate, I'm going to decrease my present value. So if I use a discount rate of 6%, the investment return, and I don't use the 3.41, the inflation adjusted, it's going to give me a present value of only $853,000. So you think to yourself, my retirement account, I only need $853,313. But that's because you've used the wrong wrong discount rate. You're not adjusting it for inflation. So here, if I keep that same inflation-adjusted series of payments that are increasing by 2.5%, what's going to happen is that with starting my account only at $830,000, I'm going to run out of money. Before I get to my 20 years, I'm going to be almost out of money at 15 years. I'm going to have a negative balance at 16 years, and I've simply run out of money. So that's the real importance, why we need to use that inflation-adjusted discount rate, okay? So if I scroll down here, another little bit of an example, what am I doing right here? Yeah. I'm not adjusting my my payments. I'm just keeping it at $70,185. So you can see at the end of 20 years, I am fine. I am down to zero balance, but I have not inflation adjusted my payments. So I'm still only getting an income of $70,185. Where, with the rate of inflation at 2.5%, those expenses are really at $112,000. So again, that is really the importance of why we need to use that inflation adjusted rate. So then down here, I'm not going to spend a lot of time on it. It's in the Excel sheet, which you can download, but it's just saying that step number 3, what's the present value that I need? 364,206. That's my balance at the beginning of the year. If I'm going to get 6%, then we know at the end of the 20 years, I'm going to get to my target of 1,039,567. Okay. The other thing that I'm doing here is I'm just making it the yearly savings, or the which at the end of the year or at the beginning of the year, and scroll down. I've also got the monthly savings. Okay. So that's 6 minutes on this Excel sheet. The key important message is that if I want to calculate $45,000 in expenses, 18 years from now is $70,000. That's the income that I want to cover the lifestyle that I want. That lifestyle is inflating at 2.5%. Then I need to make sure that I use the inflation adjusted interest rate for step number 2 to preserve that purchasing power, so that at the end of the 20 years, I'm not only, my balance is down to 0, but I've maintained the purchasing power, what started at, now I'm getting payments of $112,000. It's not at $70,000. Okay, so that's the end of this video. Thank you very much.